Hello and welcome to EG Now. We are at the Jeffries India Forum, and with me is Mahesh Nandurkar, who is the head of India Research and India Equity Strategist at Jeffries India. Mahesh, thank you very much for joining us on ET Now. Let me start off from where the index is today. We are just about 25,200 odd, and the index has been sideways and consolidating its levels. Where do you see the index moving from here on, and what are the factors that you're looking at for the index?
First of all, thanks Sanjeet for having me here. I think, as you rightly mentioned, the index has been in a consolidation phase, and I think it's a very healthy phase, in my view, because the valuations had really gone to, like one extreme, and exactly 1 year ago from the same venue, I said the same thing, that the valuations are, very elevated, and we have seen some moderation. But I think we still haven't gone down to the level where one can say that, oh, now like everything is priced in, and like go out and be like extremely bullish. I don't think we are at that stage just as yet. So the way I look at it is, over the next 12 months or so, we would still be looking at this consolidation phase, extending to some extent. So I'm still looking at a single digit kind of returns over the next 12 months. We can actually some near-term bounce, because what I'm looking at is the foreign portfolio investor positioning on India is very light. In fact, it is probably at one of the lightest levels that we've seen historically, with nearly 67% of the emerging market funds are underweight on India.
Okay.
And there are a few other things like that. So I think if there were to be some positive trigger, like let's say some kind of a trade deal happens or some kind of a improvement in the India-US trade relations, that can act as a big trigger. But yeah, but still on an overall basis with the next 12-month view, difficult to see like a double-digit returns. I would still peg returns to be in high single digits.
What's your Nifty target then for the next 12 months?
For the next 12 months, I would look at, as I mentioned, like 8-9% returns from here on. So maybe somewhere around 27 or a little bit here and there. That kind of a target is what I'll keep in mind.
So you mentioned that the index hasn't moved much. The valuations are still healthy, or uh, I won't say it's overly expensive, but
Yeah.
the earnings are the ones which are little softer, and that's keeping the valuation at where
Yeah.
it is.
Yeah. Yeah.
And it's a liquidity which is not allowing the valuation to correct in that sense.
Right.
How do you see liquidity flow in this market? Because foreigners have been net sellers for the last 1 year, if you look at how they've been selling.
Right.
But the domestic liquidity is something which is keeping the market afloat.
Oh, absolutely. So in fact, we have two very strong factors. One is the very strong domestic demand. So if you actually look at, I mean, people just focus on only one aspect of domestic demand, which is the domestic mutual funds, which are bringing in, say, about $4 to $5 billion a month into equity markets. But if you actually look at the holistic domestic institutional setup, then there is like pension money, there is this AIFs, and I think if you add everything up, it coming up to like almost $7 to $8 billion a month.
Of
So
net flows.
net inflows coming into the equity market. So very strong inflows. But at the same time, it's actually getting equally matched by very strong equity supply as well, right? We are seeing lots of IPOs, lots of follow-on offerings, promoters exiting, private equity selling down their stakes as well. And if you add up all these four aspects, it's also becoming almost that $7 to $10 billion a month. So we have very strong inflows, but equally strong outflows as well by way of corporate issuances.
And none of them is happening in the secondary market. It's happening either the primary level
No,
or
I'm including secondary market because
the block deals. You basically adding block deals as part of the secondary
yes,
market.
because when
But
a
I'm
private
talking about secondary trading actually.
yeah.
There's no trading in such. So the flows which are coming from the foreigners is basically absorbing the new float in that way.
That is true. So yeah, so we have these two so both these numbers, $7 to $10 billion a month on inflows and on the outflows, both at a very high level. I mean, we have not seen these kinds of numbers. Maybe seen these kind of numbers only in the last 12 months. And both these numbers, by the way, are market level sensitive.
Yes.
In the sense that if the markets were to go down, some of these supply will actually go down as well.
But is it such sensitive? It's not that sensitive in that sense, right? The domestic flows are sustaining even if the market is correcting.
True. No, so I'm just saying that, so in fact, I would say the domestic flows are actually supporting
Yes.
the downside.
Yeah.
And we've seen a massive buy on dips mentality.
Right.
So in fact, I would say that if the markets go up too much, then the domestic flows might come down a little bit. In fact, we've seen this massive buy the dips mentality,
Yeah.
which is protecting the downside, which is what we saw in the last 2 months as well. So the domestic flows will protect the downside, but the supply will cap the upside as well. So I think we will be moving in a narrow band, I feel. So, well, there will be a lot of sector specific ideas, there'll be a lot of stock specific ideas, but the market will probably be moving only in a narrow range in my view.
How do you see the broader markets, the mid caps and the small caps? They've been outperforming the benchmarks.
Right. So my sense is that that if we believe that the foreign investor positioning is very light, and that can be the swing factor at the margin, then I would say that incremental flows that might be coming in from the foreigner side, those could go towards some of the large cap names, essentially banks, NBFCs, because those are also attractively valued as well.
Yes.
Many of the other large cap sectors are not that attractively valued. Many of the consumer stocks are very expensive and so on. So, yeah, banks, financials could be one space which can see interest coming in from foreign investors. But also, there are very unique bottom up ideas coming up as well in, say, cement, in telecom, in some of the discretionary consumer names like airports and travel tourism theme, etc. And what the foreign investors have seen is that if you like rewind 5 years ago,
Yeah.
the benchmark, which is followed by most investors, which is MSCI India,
Yeah.
that had 80 stocks in
Yes.
the benchmark.
Yeah.
Today it's 160.
It's almost doubled.
It's almost double. So 80 new stocks have got added
Yeah.
in the benchmark in the last 5 years.
Yes.
And many of these 80 stocks are not well understood by many of these foreign investors.
The new ones.
The new ones, the new ones. And those are the stocks that have actually delivered the index outperformance, as you rightly mentioned, which went to a very high level valuation. Many of those have seen some correction in valuations as we speak. And my sense is that many of these bottom up ideas will be picked up as well. So select large caps like banks and lenders and like telecom, etc. And maybe some of these very unique mid cap ideas as well with a long term growth story.
So, what is the new pitch you're making to the investors? Because you have a lot of investors coming in, over 200, if I'm not wrong, and globally they're coming in and listening to the India market at a time when India is underweight in the emerging market portfolio.
Yes.
And it's poised to come up, but there are certain triggers that the market is awaiting.
Right.
So, what is that pitch that you're making to them with respect to where to look at those pockets where you see undervaluation and the first beneficiary of that shift that comes in?
Yeah. No, I think what we're clearly seeing is that, so first of all, as you mentioned, so we've got like more than 150 odd investors physically present here at our conference who have come from overseas. There are many others who are sort of come from Mumbai and the other domestic places as well. And as I mentioned, a lot of these investors are looking at finding out those ideas. Um, and as I mentioned, we are seeing some very, very sort of strong response to, these interesting ideas. As I mentioned, some on the airport side, which is also increasingly becoming as a consumption story, actually, because a very large part of the value is coming from passengers actually spending at the airports. So those are some of the sort of stories like that. We are seeing very strong traction coming in for cement, because this is one of the very few sectors which have seen earnings upgrades in the June quarter. And my sense is that it will be one of the very few sectors, if any, that will see EPS upgrades in September, December, March quarter as well.
You'll see pricing holding on or going up from here for them?
I think so.
Especially after the GST cut is going to be a boost.
Okay, so the end consumer price might obviously be going down because obviously the GST has come down. But I think if you look at from the company realization perspective, it will still spring a positive surprise. Because see, we have to understand that the industry has gone through a long period of consolidation during which the cement prices were actually kind of maybe flattish to declining.
Yeah.
The EBITDA per ton, the profitability has been like at a flat level for 20 years. So if you look at cement sector, EBITDA per ton has been at 1,000 rupees per ton for last 20 years now, which is in real terms, it has gone like 1/4 basically. In nominal terms, something remains flat for 20 years. In real term, it has kind of gone down to 1/4. So I think some kind of a profit normalization needs to happen in that industry, which will basically imply that the realizations will be higher and there will be surprises. So that is one very strong theme according to me. We are seeing very strong interest coming up in telecom.
But there are hardly any players, only one player there in telecom and Indus maybe.
Yeah, and maybe some new can get listed in due course of time. But I think this is also a story where the valuations. See, if you look at the broader consumption story in India, which is obviously very attractive, but the stocks are very expensive. The P multiples are like 40 times, 50 times, 60 times for many of these attractive ideas.
Yes.
But telecom is one space where we think it offers growth. It offers a play on India consumption story at a very reasonable valuation. If you look at it on an EV by EBITDA multiple basis, it's about 11, 12 times. Very reasonable, in my view. So one way to look at this would be that, oh, Indian telecom companies are the most expensive telcos globally. But that's not a fair comparison because telecom companies globally have a very, they're like low single digit growth.
Yes.
Where in India, it's a double digit growth industry.
True.
So it should be viewed as a growth, I mean, a decent, high growth consumption story and should be valued like that. That's what we feel.
And how do you convince the investor? Because while it's a cogent argument that you made about the growth which is coming in, for the investor, this has been the case for last many years. There has been portfolio reallocation that has happened as a result of which India went underweight in many cases.
Yeah.
And despite that, valuation remains constant. Liquidity is supporting that valuation in manner, and earnings are almost at a on a gradual basis is growing at a constant or sustainable rate.
Right.
So how do you convince them?
See, the thing is that, as I mentioned, we are going through a phase of consolidation. And, it's actually a time like this that you can actually try and get some, a bargain sort of, place. Because when the markets are hot and everything is looking great, then the incremental returns from there on are usually lower. It's actually a phase like this which actually offers an entry opportunity, time for investors to come and meet companies, do their homework, analyze and identify the stocks that you would like to buy. And this is a phase which is being utilized by the investors, as such. So my sense is that we are seeing a good bottoming out, kind of a pattern. And maybe, as I said, we will still see some extension of this current phase of consolidation. But I think will kind of provide good entry opportunities from a long-term perspective.
The biggest challenge is the India-US trade talks, and that's creating a lot of uncertainty for multiple sectors. How do you look at navigating this kind of uncertainty for the investors, especially when it comes to sectors like textiles, automobiles, labor-intensive sectors, or for that matter, IT in that sense?
Yeah, yeah. No, I think that's a very fair question, and it does create a lot of uncertainty. But my view is that, our house view for Jefferies is that this 50% tariffs that we are seeing right now from the US is not likely to sustain for a very long period of time. Maybe it takes a few weeks, a few months. I don't know how much time it takes, but it's certainly not something that will like go on for like years. I don't think so. So I would say that any adverse stock price or stock market reaction on the back of this could actually prove like a buying opportunity, in my view. Also, what we hear is that the government is working out, a package to support some of these sectors that are getting negatively impacted, like the textiles and the other sectors that you mentioned.
Gems and jewelries and others.
Exactly. The I would say the cushioning factor is that all these industries and the exports of these industries to the US accounts for less than 1% on a net basis. The gross numbers are slightly higher, but you look at the value addition part.
Yeah.
So I don't see the impact is going to be more than, let's say, 20-30 basis point on the lower side, assuming like 25% tariff. Or if you assume a 50% tariff, then maybe like 80 bips to 100 basis point, or like 0.8 to 1 percentage point type of an impact, which is a real impact.
Yeah.
But I think it's not like a huge impact, and maybe with some of the government measures that impact can be alleviated. But as I said, our base case is that we don't think that this situation can last forever.
A lot of policymakers are coming and speaking to investors here.
Yes.
Trying to calm their nerves with respect to the US tariff situation. What are they telling you, that it's very near and it should be done quickly?
Now I see a sense of optimism. We've got a few very senior ministers coming here, a few very senior bureaucrats as well. So I think there is that sense of I would say cautious optimism that things would get resolved sooner rather than later. So yeah, so let's see. I guess it is an uncertain time for sure, but the messaging seems to be that we should get over with this, or some kind of a resolution should be in place. Maybe, as I said, in the next few weeks or next few months.
Another big sector which is very big for the foreign investors is the IT sector. For last 3 to 4 quarters, we've been seeing this slowdown happening ever since the pause on Fed rate cut has happened. Discretionary spends have cooled off. Do you see a revival happening in the IT sector?
I think temporary sentimental revival can happen. Also because the investor positioning is sort of once again not that strong on IT sector.
They're very underweight on it actually.
Yeah, they're underweight on it. So as I said, so there could be some short-term rallies that you might see because valuations will come off. Some companies are doing buybacks as well. But I think it's a sector which is going through some of the structural headwinds in my view. The growth, the revenue growth or the EPS growth from a 3 to 5 year perspective looks like in single digits.
Okay.
And in that context, the stock trading at 23, 25 times P multiple seems a bit on the higher side. So I think it's a sector will probably have to undergo a slightly longer period of consolidation in my view. So actually in our model portfolio, we are a sector where we're recommending underweighted consumer staples, which is also once again a relatively low growth but high P multiple sector. So yeah, so these are the two sectors where we are advising investors to be underweight, to kind of go overweight on some of the other sectors that I mentioned, like telecom or cement or some of these unique bottom-up ideas.
It's interesting because you think consumer staples to be underweight, but we have a GST cut and there is likelihood of a buying spree or surge that is expected from Q3, Q4 onwards as the price gets passed on to the consumers.
Yeah.
Do you think the urban consumption will be back after this cut after September 22nd, and that could reflect in the numbers in terms of volumes and while price point of view it might be a little lower, and many other staples are talking about increasing grammages and retaining the pricing there. So the volume growth will be back for that sector.
Yeah. No, I think you're right. So GST would be a tailwind for many of these staples names, but equally the consumer durable names as well, which is the two-wheelers, four-wheelers, I would say even cement, as I mentioned. Not really on the volume side, but maybe on the pricing side for cement. So, what I believe is that yes, I mean, all these segments that you mentioned should be the beneficiaries, but I think the price sensitivity for a consumer durable like two-wheelers or four-wheeler or let's say air conditioner is like much higher.
Yeah.
I mean, if something was selling at like 100 rupees and an air conditioner, and if it's not selling at let's say 90, maybe I'm going to buy that one at 90 but not buy it at 100. But if you're buying like a toothpaste or a soap or shampoo which was selling at 100 now selling at 90, will you say that okay, I'm going to buy one more soap because now it's at 90 rupees? Maybe not. Maybe some people can, but I think the volume benefit will be much more on the durable side. not so much on the staple side.
Do you see upgrading happening because of this?
Quite possible, because premiumization has been a very, very strong trend in India.
Yeah, premium accompanied by satirization as well, right?
Yes.
So
No, I think, no, it's a very valid point. We have been sort of highlighting this as one of the key themes, that, and we're seeing this theme playing out across many categories. Look at like passenger cars, the entry level cars, demand has not been growing.
True.
Same for entry level two-wheelers. And I can give you like, so many other examples.
and companies have been pushing that, and they've not been able to break that jinx of how to generate demand for that entry level.
True.
So
So I think the best way to capture that premiumization demand is actually through travel tourism related ideas. And the second form, we've recently been highlighting alcoholic beverages as a sector. That is a great way to play the premiumization story. A lot of domestic alcohol manufacturers are coming up with very nice premium quality brands and offerings and bottle size and shapes and so on. So that looks like a great idea to me.
and the recent trade uh, agreement between UK and Australia and others also brings in that kind of premiumization into play and affordable at affordable levels.
Yes, so the imported scotch becomes cheaper as well. So yeah, so there are sort of many triggers for that.
Uh, one constant theme which is there of banking and financial services, and when the Reserve Bank of India, cut its rates by 50, one of the immediate impact was the kind of NIMS impact which will be there for banks and financial.
Yeah.
We saw banks and financials on the sideways for last few months actually.
Yeah, yeah.
You seeing that flows will start coming into this sector now?
I'm quite hopeful. I'm quite hopeful because, as you mentioned, the NIM impacting the EPS growth is now in the numbers. Maybe you will see more rate cuts. In fact, I think that maybe RBI will cut by another 25 or maybe even 50 over the next 6 months. But I think that will be it. I mean, I don't think we will be seeing higher cuts than that. So, in that sense, I would say that we are creating a low base for earnings for the banks. Next year should be a very good year in terms of the the earnings growth. And the second thing is because of the very pro growth stance adopted by the RBI, the credit growth itself should be better. Like last year was a period during which the RBI was like restricting growth in many ways.
Sure.
But now this year, most of those things have got reversed or have turned on the pro growth side. So I'm quite hopeful that the credit growth improves, margins improve because the impact of rate cuts is in the base, and I think the credit quality is holding very nicely and the worst is behind.
How do you see the capital markets sector? Because this sector is also expanding in terms of number of new companies coming in, newer asset managers, wealth managers, brokerages, discount brokers, all of them coming into this space. And with last 6 months, if you look at it, from a tax cut to a GST cut to an RBI cut, a rate cut, there is more income which is there in a household today. So, where do you see capital markets being one of the themes going forward with
I think it's a
respect to
great
money flowing
long-term
into?
theme. I think it's a great long-term theme. But given where the valuations are and given that my expectation for market outlook as a whole for the next 12 months is, as I mentioned, I'm looking at like single-digit returns over the next 12 months. And also there are some regulatory changes likely to be underway as well. So my sense is that it's a great story from a long-term perspective, but I think the investors might need to be a little bit more patient. And if one is patient, then yeah, it's a great sector. But maybe the next 6 to 12 months view, we may not really see very high returns there.
And I'm saying from a point of view of liquidity coming into this,
Yeah.
from a huge, we also spoke about $4 to $6 billion of liquidity
Yeah,
coming into
yeah.
this, and that augurs well for these kind of companies which are in this space. Of
Yeah.
course, return is going to be challenging in this short term, as
Yeah.
what you said.
Yeah.
But from a business point of view and a sector which is emerging into a big.
Oh no, structural story is very strong. There is no question about that. But what happens is, when we look at the EPS growth, it ultimately is linked to your assets under management growth, right? And the assets being managed has two drivers. One is the valuations going up, the market levels moving up or down, and the new flows.
Yes.
The new flows, well, I mean, I would say it is it is maybe like 4-5% maybe of the asset. But the real growth in asset happens when the levels go up.
True.
So yeah, so that's a bit of a thing to keep in mind.
Within your portfolio, which are the sectors which are underperforming and overweight?
So underweight sector, as I mentioned, we have consumer staples as an underweight. IT sector is an underweight. Capital market is actually an underweight, as well. Industrials is an underweight because we think, the capex spending has, been slow. So these are the 4-5 sectors, which are underweight, in our model portfolio. And as I mentioned, the overweights are, banks, cement, telecom, autos, real estate. Those are some of the overweight sectors.
And you are optimistic that the tariff would change. Means is a resolution coming in, and so we'll have a short-term bounce. But your 12-month target would be somewhere around 26,500, 27,000.
Yeah, 27 something. Yeah. So as I said, with the 12 month view, I don't think the market delivers more than 8-9% returns.
Mahesh, it was a pleasure talking to you today. Thank you very much for joining us on ET Now.
Thank you, Sujit, for having me here.
Yeah.